10-year note yields remain near the lows, but pushed up slightly after yesterday's big buying binge that we saw, pushing yields below the effective funds rate in the 10-year bucket. Right now, 10-year yields hovering just above 240. Recall when we were talking about 10-year yields trading around 3%, maybe testing 3.25% based on the Fed's unwind of its balance sheet, based on higher rates, the economy, everything seemed to be working well together. And those days seem like a distant memory. And right now the market will struggle to get back north of 2.5% for any sustained period without a catalyst event occurring. And I think that that's something that wasn't expected. The market keeps expanding the range to the downside and the yield speak. And I think that right now the market may be testing that lower end of the yield sooner than later. When you see those longer durations dip below the effective funds rate, it is almost a signal the Fed is going to be cutting rates. Now, that is not something that has been spoken about, at least in the short term. The market's certainly pricing in a cut by the end of 2019 now, fully, if you look at the Fed funds futures, but we are not hearing it from the Fed's mouth. So right now, the market is doing the talking for it. Whether things correct after this initial knee-jerk that we've seen over the last, call it 24 hours, subsides, maybe things will be more normal, but right now it seems that it hasn't. And the fact that we continue to test those low yields, at least, and not even fade them to head back towards the mean, suggests that we're probably here for a while and we'll make another stab at those lows. And if you look at market volatility, market volatility was off Monday's highs, but it's remains elevated, which it should. We broke out of the range. We're in a territory that we haven't seen since December of 2017, when yields were going higher. Now they're going lower, and the Fed has not really changed its tone very much, other than to say they may not look to hike the rest of 2019, and that was considered more hawkish now than the fact that the market's pricing in an ease suggests otherwise. But I think the volatility right now will continue to remain bid, with the idea that even if the Fed gets more involved, again, like it had during the financial crisis, in some kind of quantitative easing, the uncertainty of how it will all unwind remains very, very blurry. And that, to me, seems to be the picture here that what the Fed is creating. And so volatility should remain high. It should remain bid. There isn't really a clear picture as to how the Fed's going to handle what's going on right now with yields trading as low as they are. And lastly, let's look at the curve. Yeah, the 2-year, the 3-year, the 5-year, the 7-year, they all trade below the Fed effective rate. And as I mentioned earlier, the 10-year dipped below it yesterday. So we continue to see the very, very front end of the curve act very funny. Today we had a 2-year auction, which saw very, very strong demand and went through very strongly. So even at these higher prices and these lower yields, we are seeing high demand, which really kind of calls it maybe a have to buy and not a want to buy at this point. Yes, there are always going to be those looking to make money on a market trade, but when you see that kind of size go through with that kind of demand, it typically suggests that those people have to buy, those entities have to buy, and are looking for ways to maybe protect themselves. And so the equity markets, while they haven't seen a huge shift like we would expect with a fear trade like is being present in the bond market, I think that the yields are going to sort of force the Fed's hand, at least to do some kind of quantitative easing. Whether they bring rates down or not is yet to be seen. But the economy could have a lot to do with that if things pick up. I think the uncertainty around Brexit continues, but it's going to get kicked down another 2 weeks after the fact, that we get either a no deal or we get some kind of another extension, we'll call it, after whether it's parliamentary elections into the EU or whether it's the EU elections themselves in May. And I think that those are all going to continue to kind of hang a wet blanket over the market. But right now we are seeing treasuries on those low yields, and I guess I'm getting to the fact that they're going to probably make another stab at them before too long, despite the fact that we haven't really heard anything from the Fed since they put in those lows yesterday afternoon.